Hey everyone, Couch Investor back to another video for today. So in today's video, we're going to go over a company that a viewer during my live stream has recommended to look into because the stock is down 50% since the highs of last year, and that's Paycom. Now Paycom, if you don't know what they do, here's a little introduction. Paycom provides cloud-based human capital management or HSM solutions delivered as software as a service for small to mid-sized companies in the United States. It generates revenue from both subscription fees as well as the number of transactions that it processes. Now, throughout the years, Paycom as a business has been growing quite well. Revenues have been increasing steadily, but more recently, the company, because of a new offering called Betty, it has now hurt their own business. It has basically cannibalized their business. Now, some say this is just a short-term issue. Some say this might be a long-term issue. But right now, one of the main reasons why the stock has been hit so hard is because of that. And that's the result also of deceleration in growth for Q4 and 2024. More on that in just a bit. But first, let's have a major overlook of the stock right now. Paycom, market cap of $11.38 billion, have a forward PE of 24.7 times, which is much lower than the 5-year mean, which sits at 63.6 times. EV to EBITDA 14.6 times, price to sales 6.3 times, all of course much lower than the 5-year mean, and even still price to free cash flow 37.6 times compared to 103 times. This is in the last 12 months. If we look at shares outstanding, free cash flow per share, we know that free cash flow per share has increased throughout the years, even though shares outstanding has remained quite flat, although they have been buying back a little bit of shares more recently, but still free cash flow per share over the years keeps on increasing. Great record there. And then the EPS 5-year growth rate sits at 18%. Definitely a strong company. If we look at the analyst average price target for the next 12 months, it sits at $216, representing 9.6% upside. And then looking at what analysts are expecting in fiscal year 24 and fiscal year 2025 for sales and EPS. So sales growth of 11.2% year over year, EPS growth of 7.14%. Then fiscal year 2025, a little reacceleration there, 13.12% sales growth year over year and 14.12% EPS growth year over year. So basically double the growth rate of 2024. Now, before jumping into the Betty aspect of this video, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, talking about the Betty cannibalization here, we already have some analysts talking about that. So basically, Betty is a product that involves employees doing their own payroll and are guided to find and fix errors before payroll submissions. And this is what the CEO has said in the last earnings call. Now that more clients are achieving the return on investment that Betty has to offer, it has eliminated certain billable items, which is cannibalizing a portion of our services and unscheduled revenues. Again, this is something that probably inside the company they knew this was going to happen, but maybe not as fast as it did. According to an analyst here at Deutsche Bank, Betty is leading customers to spend less on services and unscheduled payroll runs, which is negatively impacting monetization opportunities for Paycom. And I continue with a couple of things that were mentioned during the earnings call. So perfect payrolls eliminate these common issues after the fact payroll corrections that would otherwise be billable. So the more employees do their own payroll, the greater the savings delivered to the client from Paycom future billings, which results in lower related revenue recognized by Paycom. So again, great for the user, not so good for Paycom at the moment. They said here with regards to the expectations for 2024 year-over-year revenue growth, now expecting between 10 to 12%. We'll have more visibility when we provide formal guidance in early February. So definitely a big deceleration in year-over-year growth. Then one analyst here asks, it took a while until an analyst asked an important question in my opinion. So he asks here, I understood that Betty now seems like cannibalizing your service revenue, but have you thought about the incremental revenue that you could get from Betty or even raising pricing? I understand you even did it for free. Now, of course, in a typical earnings call fashion, management did not really provide a straightforward answer. But in my opinion, it makes sense, right? You're offering this service. They probably knew very well that this service was going to cannibalize some chunk of their revenue, right? I mean, they own the company, they operate it, they know what they're doing, hopefully. So it is about the long-term game here. It's about maybe locking in more and more clients, right? Locking in external clients as well. Offering a great service, a service that users love because it saves them money. I mean, nobody loves saving money more than clients that are using a service. And then when you locked those clients in, you start cross-selling other products and services. And then who knows, maybe in the future, they will increase prices. And so the difference here between the cannibalization and what the actual result would have been would be a bit closer. Remains to be seen. That's why the market has punished this stock, because of the uncertainty. Is this a short-term issue or is this a long-term issue? Remains to be seen. Then just to show you why this is a big deceleration in growth. So basically last quarter, the revenues came in 22% higher than the same period last year. Net income $75 million, representing 19% of total revenues, or $1.30 per diluted shares. Recurring revenue increased 21.5%, and that's basically 98.1% of total revenues. Now, this company barely has any debt. Total debt, $29 million. Cash and cash equivalents of $484 million. And for the outlook, actually before we go to the outlook, I want to show you something. So the funds held for clients sits at basically $1.9 billion. And this is money that they can keep and they can earn interest on as well before paying those clients. Of course, with interest rates expected to go down, they'll earn a bit less in the future. Now, with regards to outlook, total revenue in the range of $420 and $425 million, missing expectations by a little bit. The same with total revenue for 2023, $1.67 to $1.68 billion, also missing the expectations a little bit, and the same for adjusted EBITDA. And so if we go and look at the graph, of course, you guessed it, if we zoom out completely, we can see that the bottom here, November 2023, $157, was around the same price the stock bottom back in March of 2020. Now, currently, the stock has gone up a little bit, has recovered a little bit, but we got rejected here at the 50-day moving average, and we are now sitting, let's say, between the 50 and the 20-day moving average before the market opens. The 200-day moving average sits at $259. RSI is pretty low, but not oversold anymore on the weekly. I think it's very important to know that this is still a very, very good company, a good business, a strong cash generating business as well. But in the short term, again, the market does not like uncertainty. And so in the short term, yes, this stock has been punished, and I'm sure that a lot of investors are eagerly waiting for that next earnings report, especially the earnings call, that should provide maybe a clearer picture on what is happening inside the company and what is happening with that Betty cannibalization. Is that going to continue? Are there ways that the company will monetize this better so they can recover, let's say, the losses because of Betty? Remains to be seen. I'm watching this closely because, again, great company, great business, cash generating business, as well as we've seen free cash flow per share has kept on increasing year over year. Short-term issues, let's hope it doesn't resolve in long-term issues for that company. So that will be it for this video. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.